Welcome to the DX Today podcast, where you get facts, not hype. I'm your host, and today we are doing something a little different. We are taking the stack of reports, the regulatory guidance, and, frankly, the industry panic on my desk, and we are stepping squarely into the present moment, February 2026.
It is a fascinating, albeit, incredibly stressful time to be looking at the banking industry. The initial gold rush of the AI boom from 23 and 24 has settled, and the dust is cleared. Now we are standing in the thick of operational reality.
And that reality is a bit of a pressure cooker. We're calling this deep dive the governance gap. Because if you are running a regional or community bank right now, let's say you're sitting on anywhere between, 10 billion and 250 billion in assets, you are feeling a massive, crushing squeeze.
Oh, absolutely. It feels almost existential.
It really does.
And to understand why that squeeze is happening, you have to look at the competitive landscape here in 2026. It's become completely polarized. On one side, you have the G-SIBs, the global systemically important banks. We're talking J.P. Morgan, Bank of America, the absolute giants.
Held names.
Right. And they've taken what I like to call the Death Star approach.
A Death Star approach. I like that. Explain.
It's total internal dominance. They have armies of data scientists, literally thousands of them. They have billion-dollar budgets for R&D. They are building their own proprietary AI models for everything from credit underwriting to fraud detection, all in-house on their own servers with their own code.
So they own the entire stack. They control their own destiny.
Precisely. But then you have everyone else, the regional banks, the community banks. They don't have those armies. They don't have the budget to hire 500 PhDs to go build a custom large language model from the ground up.
Of course not. That's more than their entire IT budget for a decade.
Exactly. But, and this is the crucial part, this is the squeeze to survive in this digital economy. To compete for customers who expect instant loan approvals and real-time fraud protection, they must use AI. There's no other way.
Right, because if I can get a mortgage approved in 10 minutes on my phone from a G-SIB, I'm not going to wait 3 weeks for a regional bank to process paperwork manually. I'm just not.
You're not. You've lost that customer forever. You become obsolete. So the regional banks are completely stuck. They can't build it, but they have to use it. So what do?
They buy it.
They buy it. They turn to third-party vendors. And that is where the trap snaps shut. Because while the technology has leaped forward in these last couple of years, the regulations have dug in their heels. They haven't budged.
And that's the governance gap we're talking about.
Precisely. The governance gap is this dangerous disconnect between the automated compliance solutions that tech vendors are selling, promising you can just plug it in and forget it, and the rigorous, almost, aggressive demands for effective challenge that federal regulators like the Fed, the OCC, and the FDIC are enforcing.
And just to be clear, we aren't talking about a slap on the wrist here, are we? If you mess this up, it's not just a bad day at the office.
Oh, no, this isn't a parking ticket. This is a matter requiring attention, an MRA. It's a formal enforcement action. It's your board of directors getting dragged into a windowless room with examiner.
That sounds unpleasant.
It is existential risk. The mantra from the regulators is simple. If you cannot explain your AI, you cannot use your AI. And if you can't use your AI, you might not have a bank in 5 years. It's that stark.
Okay, let's unpack this. We have a lot of ground to cover. I think a good roadmap would be to look at the want, what the regulators are actually demanding from you. Then we'll look at the sell, what the vendors are promising.
And then the friction, where those two worlds collide. Because they do, very violently.
Yeah, the IP walls, the black boxes, all that fun stuff. And finally, we'll talk about how banks can actually survive this. What are the strategies?
And we should wrap up by looking at the specific legislative landscape right now. In 26, things like the Genius Act and the White House AI Action Plan, because they're shaking things up even more.
Perfect. So let's dive into part one, the regulatory siege, or as I like to call it, the want. So set the scene for us. It's 2026. We have agentic AI. We have generative models doing things we couldn't have imagined a few years ago. But the rule book everyone is playing by. It isn't new at all, is it?
Not even close. It's almost comical. The Old Testament of AI governance, the document everyone keeps pointing back to, is still SR 11-7.
SR 11-7.
Sounds like a droid from Star Wars.
It does, doesn't it? But it stands for Supervisory Guidance on Model Risk Management. And get this, it was issued back in 2011.
2011.
11. That's ancient history in tech years. That's pre-TikTok, pre-Chat GPT. That's when we were all worried about, the Facebook IPO.
Exactly. It was written to address the financial engineering disasters, the complex derivatives that caused the 2008 crisis. But here we are, 15 years later, and regulators are applying their same fundamental principles to the most advanced neural networks on the planet.
So why? Is it just, are they just behind the times, or is there a logic to it?
Well, their argument is that the core principles are timeless, and the central pillar of SR 11-7, the idea that's causing all the grief, is this concept of conceptual soundness.
Conceptual soundness. Okay, that sounds like a philosophy term. What does it actually mean for a banker trying to get a model approved?
In plain English, it means you have to know why a model works, not just that it works.
Okay, an example would help.
Sure. Back in the day when we used linear regression for credit scoring, this was easy. You'd have variables like your debt-to-income ratio or your history of late payments.
Right. And that makes sense. If I have a ton of debt and not much income, I'm a bigger risk. It's logical. It's causal.
Exactly. It aligns with basic economic theory. You could look at the math and say, yes, as debt goes up, risk goes up. But the AI problem is different. Modern neural networks, deep learning models, they don't find simple linear relationships. They find these incredibly complex nonlinear correlations. They find patterns that are mathematically strong, but economically invisible.
Give me one of those economically invisible examples.
Okay, here's a real-world sort of gray area. Let's say a neural net figures out that people who charge their phones between 1:00 p.m. and 3:00 p.m. are better credit risks than people who charge them between 2:00 a.m.
Okay, I can almost invent a reason for that. Maybe the night chargers have less structured jobs or something.
You can invent a story, but is it conceptually sound to deny someone a mortgage because of their battery habits? Can you stand in front of a regulator or a judge and defend that as a causal driver of credit risk?
No, absolutely not. That sounds like nonsense. And it feels discriminatory somehow.
It feels like a proxy for something else. And to a regulator, complexity does not excuse opacity. The OCC has been crystal clear on this. If a bank cannot explain how a model arrived at a decision, if they can't articulate that causal link we talked about, then its conceptual soundness is, and this is their term, technically unproven.
So if an examiner walks in and asks, why did the model pick variable X, this phone charging variable? And the banker says, well, the computer said it improved the Gini coefficient by 0.02? That's a fail.
That is a spectacular fail. That is an immediate giant red flag. You cannot use mathematical optimization as a substitute for economic rationale. You have to tell a story.
Okay, so that's conceptual soundness. This brings us to the other big buzzword that I hear constantly, the one that regulators seem to love, effective challenge.
This is probably the #1 failure point for regional banks right now. It's where the rubber meets the road on governance. Effective challenge basically means you need someone qualified to kick the tires. Hard.
Okay, just kicking the tires. Sounds simple enough.
It sounds simple, but SR 11-7 has a very specific tripartite requirement for who gets to do the kicking. You can't just have anyone do it.
The 3 pillars of kicking, what are they?
Independence, competence, and incentive.
All right, break them down for me. Let's start with independence.
First, independence. The person or the group challenging the model cannot have a stake in its success. They can't have any skin in the game.
So you can't have the sales team validating the pricing model they need to hit their quota.
Exactly. And you can't have the developer validating their own code. It seems obvious, right? It's like grading your own homework. But you'd be surprised how often that line gets blurred, especially in smaller institutions where everyone wears multiple hats.
I can see that. Okay, so independence is #1. What's #2?
#2 is competence. And this is where regional banks really, really struggle. The challenger must have the technical expertise to actually critique the model's architecture, to pop the hood and understand the engine.
Right, so your internal audit team, they might be brilliant at auditing wire transfers or cash drawers.
Yeah.
They've done it for 30 years.
They're experts at that. But do they know how to dismantle a gradient-boosted tree model? Can they look at the code for a neural network and spot a potential for overfitting or data leakage?
Probably not. They're accountants and auditors, not data scientists.
Exactly. So the bank has a competence gap. They don't have the in-house talent to perform a credible challenge.
Which forces them to look outside, which is a whole other can of worms. Okay, so independence, competence. What's the third pillar?
The third is incentive, and this one is more about power and politics than anything else. The challenger must have the authority and the institutional backing, the safety, to stop a profitable launch if they find a legitimate risk.
So they have to have real teeth.
Real teeth. Imagine this scenario. The bank is losing market share to JP Morgan. The business line is screaming that they need this new AI underwriting model now to compete. It's projected to bring in millions in new revenue. The risk officer looks at it and says, hold on, I don't understand the weights on these variables. It looks like a black box to me. I'm not signing off.
That is a tough spot to be in.
Does that risk officer have the political capital to kill that project, or are they going to get enormous pressure from the CEO and the board to just find a way to get comfortable with it? That's the incentive question.
And I imagine a lot of banks try to sidestep all of this by falling into what you call the vendor trap.
They do. It's so tempting. They buy a solution from a big, reputable vendor. The vendor hands them a glossy 500-page validation report with a nice bow on it. It's got charts, graphs, statistics. It looks incredibly official.
So the bank just forwards that email to the regulator and says, look, we're good. The vendor validated it.
And the regulator looks at it and says, this is marketing material. This is not governance. Relying on a vendor's own validation is not effective challenge. It violates the independence principle right out of the gate. The vendor is marking their own homework.
Wow, so you can't just trust the brochure. Now, things got even stricter, you mentioned. In 2023, there was this new critical activity standard. What changed there?
Right. The interagency guidance on third-party relationships came out in June 2023. It wasn't about AI specifically, but it had massive implications for it. It introduced a very specific definition for a critical activity.
And that definition is?
An activity is critical if its failure could cause significant harm to the bank or, importantly, to its customers, or if it impacts the bank's financial condition or operations in a major way.
Which, by 2026 standards, is basically everything AI touches.
It's everything. Credit underwriting, critical. A failure there means bad loans or discrimination. Fraud detection, critical. A failure means massive losses. AML, critical. Chatbots giving financial advice.
That's consumer harm.
Critical. Correct. So almost any high-value use case for AI now falls under this critical activity umbrella.
So what happens when that flag goes up? What happens when something is deemed critical?
You get on what I call the diligence escalator. It goes up fast. Those standard vendor questionnaires, the spreadsheets you send out asking, do you have a firewall? Or are your employees background checked? Those are basically garbage now for critical activities.
Not nearly enough.
Not even close. You have to go deep. You have to do technical reviews. You have to demand access to testing environments. And most terrifyingly, you have to look at fourth parties.
Fourth parties. Okay, so not just who I hire, but who they hire.
All the way down the chain. Let's walk through it.
Yeah.
You are the bank. You hire a cool fintech vendor to do your fraud detection. That's the third party.
Got it.
But that vendor runs their software on Amazon Web Services. And maybe their model calls an API from OpenAI to process text from customer chats. AWS and OpenAI are the fourth parties.
And I, the bank, am responsible for them.
You are.
But I don't have a contract with AWS or OpenAI. I have no leverage over them.
Doesn't matter. The regulator says they are part of your critical activities supply chain. So if OpenAI changes its API terms tomorrow and stops supporting a feature your model relies on,
my fraud model breaks.
And that is your problem. If AWS has a massive data center outage in Virginia, that's your problem. If the foundation model provider, the fourth party, changes its data privacy policy and starts training its next-gen model on your customer data.
That is a massive compliance violation, and it's on me.
It is on you. The bank is on the hook. It's a terrifying amount of responsibility for a supply chain you can't even fully see, let alone control.
It feels like you're responsible for the entire internet.
In a way, you are. And that brings us to part two. Because while the regulators are demanding this, frankly, almost impossible level of deep, invasive oversight, the vendors are out there telling a very, very different story.
Right. Part two. The vendor mirage. I love this section. Because if you go to a fintech conference, and I know you have, the booths are shiny. The slogans are so catchy. Regulator ready, audit-proof, one-click documentation.
It's incredibly seductive. And you have to have some sympathy. If you are an overworked chief risk officer at a $20 billion bank, you're understaffed, you're under-resourced, and a salesperson from a company like DataRobot or H2O.ai or Zest AI tells you, hey, our AI platform generates its own compliance paperwork, that sounds like a lifesaver.
It sounds like the easy button. But let's play Mythbusters here. What's the reality of automated documentation? You see that promise everywhere.
The reality is that it's often a liability, not an asset. Look, these tools, I want to be clear, they are powerful, brilliant technological platforms. I'm not knocking the core tech, but when they say they automate documentation, what they usually mean is they generate a 500-page PDF file that lists every hyperparameter, every feature weight, and every training epoch for the model.
That sounds incredibly thorough. Too thorough, maybe.
Oh, it's thorough data dumping. But remember, SR 11-7, it doesn't ask for data. It requires critical analysis. A regulator doesn't want a phone book of numbers. They want a narrative. They want to know why you chose those hyperparameters, why those features were deemed acceptable. An automated report cannot do critical thinking. It can't explain the why.
So you hand the regulator this 500-page robot-written report.
And the first question the regulator asks is, have you read this? Has a qualified human in your organization read this, understood it, and signed off on it?
And if the answer is no, but the software generated it.
You've just admitted you don't understand your own critical activity. You've admitted to negligence. A report no human has read is not an asset. It's a confession.
Ouch. That is a brutal trap. Okay, what about these model registries? Vendors sell them as this central command center, a way to see everything in one place.
They sell inventories. A registry at its core is just a filing cabinet, a list. Knowing you have 50 models is step one, and it's an important step one, but regulators want risk management, not just inventory management.
What's the difference?
They want risk tiering. Which of your 50 models are high risk, critical activities, which ones are low risk? They want to see monitoring results, which models are degrading in performance, which ones are showing drift. And they want retirement strategies. When do you pull the plug on an old model? Vendors sell you the list. Banks still need the risk officer to make sense of it.
And then there's drift monitoring. That sounds like something from Fast and Furious, but I assume it's about data changing over time.
Right. A model is trained on historical data, but the world changes. So drift monitoring is essential. The vendor sells you the alarm. Beep, beep. The data has drifted. The economy has changed. The inputs look different from the training data.
Which is useful. You need to know that.
You absolutely need to know it. But the vendor doesn't sell you the fire department.
The fire department.
The alarm goes off. What do? Who fixes it? Who investigates if the drift is a real problem or just a temporary seasonal fluctuation? Who has the authority to retrain the model or take it offline?
The bank has to do all that.
Exactly. The vendor sells the alert. The bank must provide the entire remediation process.
One of the most controversial things I see marketed, especially in the last year or so, is fairness as a service. Vendors are literally saying, we have a fairness optimizer. You can just toggle a slider in our software between profit and fairness.
This is the fairness as a service paradox, and it is incredibly dangerous for banks.
Why? I mean, on the surface, who doesn't want to be more fair?
Of course, everyone wants to be fair. But fairness is a complex legal and ethical determination, not just a math problem that you can optimize. If you use a vendor tool to optimize fairness, you might actually be breaking the law.
How is that possible?
Well, you can run into a situation where you are engaging in disparate treatment in order to cure disparate impact.
Okay, you have to translate that for me.
Disparate impact is when a neutral policy accidentally has a negative effect on a protected group. Disparate treatment is when you intentionally treat different groups differently. If the tool says, to make this fair for Group X, we need to boost their approval scores by 5%, you are now explicitly using their group status in your decisioning process.
Which could be illegal under the Equal Credit Opportunity Act, ECOA.
It very well could be. So the tool you bought to fix a potential discrimination problem ends up causing a definite discrimination problem. And more importantly, from a governance standpoint, you cannot stand in front of an examiner and say, the software said this was the fair option.
You can't blame the machine.
You can't outsource your conscience or your legal liability to an algorithm. The bank has to own that trade-off between risk, profitability, and fairness. You have to be able to justify that decision yourself in plain English.
It really seems like there is no such thing as a regulator-ready sticker you can just slap on a piece of software.
There isn't. It's a myth. There is no UL label for banking AI. No software is pre-certified by the Fed or the OCC. A model that passes an audit at a lightly regulated fintech startup might fail miserably at a conservative, federally chartered regional bank because the risk appetites, the customer bases, and the regulatory expectations are completely different. It's all contextual.
Before we move on from the vendor mirage, I have to ask about the big one, the ultimate safety net, the human in the loop. Everyone says, don't worry, our AI isn't fully autonomous. We have a human in the loop.
Ah, yes, the human-in-the-loop fallacy. It's the security blanket that everyone clutches, especially with agentic AI becoming more common.
Why do you call it a fallacy? It seems like a good idea.
It is a good idea in theory, but it breaks down for two reasons in practice. First is simply scale.
The volume is too high.
Exactly. If you have an AI agent processing 10,000 fraud transactions a second, real-time human oversight is physically impossible. You can't hire enough humans to watch the matrix code scroll by. It's not feasible.
Okay, that makes sense. What's the second reason?
The second, and I think more insidious reason, is something called automation bias.
Automation bias.
It's a well-documented psychological phenomenon. If a system, an AI, a machine, whatever, is right 99% of the time, the human reviewer stops paying attention. They just trust it. They get complacent and click approve, approve, approve.
They become rubber stamp.
They become a rubber stamp, and examiners know this. They're trained to spot it. If they audit your process and see a human approving 99.9% of the AI's recommendations without any changes or escalations, they don't call that an effective control. They call it a rubber stamp. Vendors can sell you the interface for the human, but they cannot sell you the vigilance. That has to come from your culture.
So we have the regulators demanding this deep, comprehensive, human-centric perfection, and vendors selling a mirage of push-button automation. That leads us directly to part 3, the friction points. This is where the rubber meets the road, and usually where the tire blows out.
And the biggest, sharpest piece of glass on that road is the IP wall.
IP meaning intellectual property, the vendor's secret sauce.
Yes. This is the fundamental conflict. The bank, trying to satisfy its regulators, says, to prove conceptual soundness, to do my effective challenge, I need to see the code. I need to see the model weights. I need to get under the hood.
And the vendor says?
The vendor says, absolutely not. That is our trade secret. That is our entire business. If I show you the code, you might steal it, or your consultant might, or it might leak on the internet. I can't do it.
Which, from their perspective, is a reasonable position.
It's a completely reasonable business position. But then the regulator steps into the standoff and says,
they don't care about the vendor's business model.
Not at all. The regulator takes a very hard line. The OCC specifically states in writing that a vendor's refusal to share information does not excuse the bank from its risk management responsibilities.
Wait. So the regulator is actually saying, I don't care that Microsoft won't show you the source code for their Azure model. You, the $10 billion bank, still have to validate it as if you had the code.
Yes, that is exactly what they're saying. And their conclusion is, if you can't see inside the box, you generally cannot use that box for critical activities.
That seems impossible. It's a catch-22.
It feels that way to the banks. The vendors try to bridge the gap. They provide these generic white papers. Here is a 20-page document on how our model works in theory. But examiners are increasingly rejecting those. They say, I don't care how it works in theory for all your customers. I want to know how this specific instance of the model works with this bank's specific data for this specific use case.
And the white paper can't tell you that.
Never. Which leads to the next friction point. Even if you want to negotiate for more access, you run into the market power mismatch.
This is David versus Goliath.
It's worse than that. It's an ant versus Goliath. A $10 billion community bank is on a conference call with the legal team from Microsoft Azure or FIS or Fiserv. They have zero leverage.
You can't just call up Satya Nadella and say, hi, I'm the CEO of a small bank in Iowa. Please change your global terms of service just for me.
Exactly. It doesn't happen.
Right.
So banks are forced into these click-through contracts, standardized terms. And buried in the fine print of these contracts are clauses that disclaim all liability for AI hallucinations or bad outputs. They severely limit the bank's audit rights.
So let me get this straight. The bank signs a contract that says, if the AI messes up and tells a lie, it's not the vendor's fault. But the regulator's standing on the other side saying, if the AI messes up and tells a lie, it is 100% your fault.
Precisely. You are caught in the middle. And examiners are now issuing MRAs specifically for this. They are citing banks for signing contracts that prevent effective risk management. The bank says, we had no choice. It was take it or leave it. The regulator's response is, then you should have left it. You shouldn't have used the vendor.
That is just brutal.
Yeah.
Now, I want to pivot from the bank's risk to the consumer side of this. The CFPB, the Consumer Financial Protection Bureau, they've basically declared war on the black box, haven't they?
They absolutely have. Circular 2022-03 was the shot across the bow. It's a landmark document. It effectively killed what was known as the black box defense.
What's the black box defense?
For years, it was when a bank said, We denied your loan application, but we can't tell you the specific reasons why because our credit scoring algorithm is a proprietary trade secret and it's too complicated for us to understand.
They would just hide behind the complexity.
Yes,
Oh.
and the CFPB came out and said, no, that is over. Complexity is not a legal defense. In fact, it is a confession of noncompliance. Under the law, you must provide specific, accurate reasons for taking adverse action, like denying a loan.
So you can't just say your score was too low or you represent a generic credit risk.
No more. You have to be specific. Your debt-to-income ratio was too high, or the time since your last credit inquiry was too short. Things a consumer can actually understand and potentially act on.
This is where the tech guys and the vendors usually jump in and say, don't worry, we have a solution for that. We have SHAP values. We have Shapley values.
SHAP, the magic wand of explainability. It's offered as the silver bullet for this CFPB problem.
So what is SHAP in simple terms?
It's a technique borrowed from cooperative game theory. It tries to explain a complex model's decision by looking at all the inputs and assigning a contribution value to each one. So for a given loan denial, it might say, your income contributed plus 50 points to the score, but your number of credit cards contributed negative 20 points.
That sounds good. It sounds like exactly what the CFPB wants. Why is it a friction point?
Because of something called the fidelity gap. Academic and industry research has shown that these explanations are just that, explanations. They are post hoc approximations. They are a story we tell about what the model did after it did it. They aren't the model itself.
They're not a perfect reflection of the model's internal logic.
Not always. There can be a gap between what the explanation says and what the model actually did.
Give me the nightmare scenario for a bank relying on SHAP.
Okay, here's the nightmare. A customer is denied a loan. The bank runs the SHAP tool to generate the adverse action notice. The tool says the top reason for denial was low income. So that's what the bank puts in the letter to the customer.
Seems fine so far.
But the model, in its complex, nonlinear way, actually denied the person because of their zip code, which in this particular city was acting as the very strong proxy for race.
Oh boy.
So now the bank has committed 2, potentially 3, major violations. First, a possible fair lending violation because the decision was based on a racial proxy. Second, a definite violation of the adverse action notice requirement because they lied to the consumer about the reason for the denial.
And they thought they were safe because they bought the explainability module from the vendor.
Correct. The regulator looks at that fidelity gap and says, this explanation tool is not accurate enough to be used for legal compliance purposes. The tool designed to keep you out of trouble just got you into double the trouble.
Okay, this is getting depressing. I feel like if I'm a regional banker listening to this, I'm ready to just give up. It feels like you're doomed. They can't build it, they can't buy it without taking on massive risk, and the tools designed to explain it might be lying. Is there a way out? This brings us to part 4, the survival guide.
There is a way out, but it requires a fundamental shift in strategy. You can't just buy software anymore. You have to build a governance ecosystem around the software.
Let's start with something you call compensating controls. If I can't see the code, if I can't open the black box, how do I possibly validate it?
You validate it from the outside. You don't try to open the box. You build a bigger, stronger box around it. You box in the black box.
How do you do that?
The gold standard for this, and what examiners are really starting to look for, is a technique called proxy modeling, sometimes called a challenger model.
Okay, explain that. What's a proxy model?
You, the bank, build your own simple, transparent, interpretable model. Maybe it's logistic regression, something old school that you fully understand where every variable makes economic sense.
Okay, so I have my simple, dumb model.
And you run your data through your simple model, and you run the exact same data through the vendor's fancy, complex AI black box.
And now I have 2 scores for every applicant.
And you compare them. For 95% of your applicants, the scores will probably be pretty close. The AI says approve, your simple model says approve, great. But you're looking for the divergences. When the AI gives a massive approval and your simple model screams high risk, reject, you flag that application for manual human review.
So you're basically using the simple model as a BS detector for the AI.
It's exactly that. It's a sanity check. It provides that effective challenge that the regulators want. It proves to the examiner that you aren't blindly trusting the black box. You have an independent, conceptually sound view of risk running alongside it.
That's really smart. What about outcome testing? I've heard that term as well.
That's another form of black box testing. You treat the model like a sealed box and you just poke it with different sticks to see how it reacts. You feed it synthetic data.
You mean like trash test dummies for a car?
A perfect analogy. You create data sets that represent extreme scenarios. You feed it data from the 2008 financial crisis. Does the model's performance collapse? Does it start making crazy decisions?
You can test for bias that way, too.
Absolutely. You take a data set of approved loans and you programmatically flip the gender variable from male to female, but leave every other variable, income, debt, credit score, exactly the same. Then you run it back through the model.
And if the decision suddenly changes from approve to deny,
You know you have a bias problem, you've proven it, even if you can't see the specific weights in the code that caused it. This is the kind of evidence examiners want to see. They care less about you reading the source code and more about seeing proof that you have rigorously tested the model's behavior under stress.
and then, on the more automated side, I've heard of circuit breakers.
This is a crucial control. It's about setting automated shutdowns. You define your risk appetite in advance, quantitatively. You say, if the model's approval rate for a certain demographic shifts by more than 5% in a week, or if the overall Gini coefficient drops by 3 points, the system automatically shuts off. It pulls the plug.
With no human meeting required to make the decision.
No, it's pre-authorized, automated. This shows active management to the regulator. It tells them, we have a safety switch and we aren't afraid to use it.
Okay, so those are technical controls. But what about the David versus Goliath problem? How does a small bank fight back against Microsoft or FIS in a contract negotiation?
You stop trying to be David. You join an army. This is the consortium strategy.
The strength in numbers.
Exactly. We're seeing the rise of groups like the Alloy Labs Alliance. They function as a kind of collective bargaining unit for innovation and vendor management.
So how does that work in practice for model validation?
Well, instead of 50 small banks each trying to do their own shallow, under-resourced, and frankly kind of crappy review of a new vendor, the alliance pools their money. They do one massive, forensic, 50-page technical validation. They hire the best third-party experts. They have the leverage to grill the vendor and get real answers.
And I'm guessing the vendor is much more likely to listen because the alliance represents the business of 50 banks, not just one.
Of course. And that single high-quality report carries way more weight with an examiner than 50 flimsy ones. It's more cost-effective for the banks, and it's a much more robust form of governance.
And then there's Sardinex. That's a consortium for data sharing, right? Not just for validation.
Yes. This solves another huge problem for regional banks, which is the cold start problem. To train a good AI fraud model, you need tons of data on what fraud looks like.
But if you're a smaller bank, you just haven't seen enough fraud to have a good data set.
Right. You don't know what you don't know. Sardinex is a data consortium that operates under a special provision, Section 314B of the Patriot Act.
The Patriot Act. That sounds intense.
It is, but in a good way here. It provides a legal safe harbor for financial institutions to share information with each other about suspected money laundering or terrorist financing, or in this case, fraud. So banks can pool their bad guy data without violating privacy laws.
So if a new type of check fraud hits a bank in Ohio, the member bank in Texas knows about that fraud signature almost instantly.
And their shared AI model learns from it instantly. It allows a network of regional banks to have a shared brain that can rival the sheer data scale of a single GSIB. It levels the playing field.
That is a real game changer. Okay, so we have technical controls like proxy models, we have organizational strategies like consortia, but what about the people? You mentioned this idea of building a governance culture.
This is the hardest part, but it's the most important. You have to move your organization from seeing compliance as a checklist to seeing compliance as a culture.
No more just checking the box and moving on.
It has to be embedded in everything, and it starts with cross-functional committees. You cannot let the IT guy or the business line manager sign the contract for a new AI tool on their own.
You need everyone in the room.
You need legal, credit, compliance, IT, and the business line all in the room with a formal process before the contract is signed. They all have to understand the risks and sign off on them.
And what about the board of directors? How involved do they need to be?
They need AI literacy training. They don't need to become coders, but they absolutely need to understand the core concepts. They need to know the difference between precision and recall in a fraud model. They need to understand what concept drift is and why it matters.
So they can ask the right challenging questions of management.
Exactly. If a board member can ask a chief risk officer, how is this new underwriting model going to handle concept drift in a rising interest rate environment? Wow, that is an effective challenge from the very top. If they just ask, is it accurate? That is not enough anymore.
And you mentioned something earlier I want to come back to. having a quantitative risk appetite.
Yeah. Yes. Stop with the vague promises in your board policies. Don't just write, "We want our models to be fair." That's meaningless.
So what's the alternative?
Put a number on it. Write a policy that says, "We will not deploy any model where the adverse impact ratio between any two demographic groups is below 0.8. Set a hard mathematical floor. Give the model developers and the vendors a target they cannot miss without triggering a full-scale review and an alarm."
That clarity seems absolutely essential. Okay, so this is the survival guide for today. Let's look forward. It's February 2026. What is coming down the pipe later this year that's going to change the game again? This is part 5, the future regulatory horizon.
There are two big things on the horizon for late 2026. The first is the downstream effect of the Genius Act.
That's the big stablecoin bill that passed in July of 2025, right?
Yes. The Guiding and Establishing National Innovation for U.S. Stablecoins Act.
That's a mouthful. But that's about crypto and stablecoins. Why does it matter for a bank's AI governance program?
It's about the spillover effect. The Genius Act mandated, for the first time, monthly attestations and rigorous annual audits for digital asset issuers. It created a muscle memory within the federal regulatory bodies. Examiners are now used to demanding this near real-time auditability and transparency.
So they are taking that intense crypto scrutiny and they're starting to apply that same mindset to AI models.
Exactly. The audit culture is spreading. They see a complex, algorithmically managed system, and now their default expectation is that level of rigor. Plus, the act allows non-bank fintechs to issue their own stablecoins, which means even more competition for regional banks' core business.
Which puts more pressure on those banks to adopt AI even faster to cut costs and improve service.
Which, in turn, increases the risk of them cutting corners on governance to keep up. It's a vicious cycle.
Okay, so that's the Genius Act. What's the second big thing on the horizon?
The America's AI Action Plan. This was a big executive action from the White House, also released in July of 2025.
What's the headline there? What's the big idea?
The central tension is deregulation versus preemption. The main goal of the plan is to preempt that confusing patchwork of state-level AI laws.
Oh, thank goodness. So we don't have to comply with the Colorado AI Act and the New York City local law 144A and the half dozen new California laws?
That is the hope, to create one single federal standard for AI risk management and disclosure. But here's the catch. If the states are effectively kicked out of the AI regulation game, the federal regulators, the OCC, the Fed, the FDIC, might feel the need to become more aggressive to prove to Congress and the public that they aren't going soft on risk.
So you trade 50 annoying mosquitoes for one giant watchful eagle.
That's a great way to put it. And to make it even more complicated, there is a task force challenging the legality of those state laws right now, which means we are in a period of what I'd call litigation uncertainty. Through the end of 2026 and probably into 2027, we won't really have a final answer on who is in charge of which rule.
So banks have to be prepared to comply with the toughest possible interpretation, no matter where it comes from.
Flexible, robust governance is the only way to survive that kind of uncertainty.
This has been, frankly, a little terrifying, but also incredibly clarifying. Let's bring it all home. What's the final takeaway?
If there is one summary, it is this. The governance gap is widening, not shrinking. Regulators are demanding more human accountability, more deep understanding, more storytelling. At the same time, vendors are selling more automation, more efficiency, more black boxes. Those two things are moving in completely opposite directions.
And that regulator-ready sticker.
It's a mirage. Do not trust it. Do not buy it.
So the real path forward, the solution, is what you might call augmented governance.
Yes. It's not about automated compliance. It's about using technology to augment human oversight. Use the AI, but wrap it in human capital. Use the consortia to gain leverage. Use proxy models to challenge the black box. And most of all, empower your people to say no when they don't understand something.
So in this new era of agentic AI, the ultimate safe harder isn't some software certificate or a fancy report. It's the ability to sit across the table from a regulator and explain in plain English why the machine did what it did and why it was safe, sound, and fair to let it happen.
Couldn't have said it better myself. That is the new standard.
That's it for this deep dive. Good luck out there and watch those black boxes. Thanks for listening to the DX Today podcast.
Stay safe.